Typically, the job of a portfolio manager, whether he or she is working in a mutual fund, in a PMS structure, in a AIF structure, or a hedge fund, or for that matter, even in a private equity structure, is to give returns to an investor which is higher than a benchmark. Retail investors and also institutional investors are human beings. They get influenced by the mass psychology. So, if a certain sector is in flavor and many people are applying and making money, there's a tendency to extrapolate that into the future, that this last few IPOs on listing, it's going up 30%, so we can make a quick money, let's participate. And more people get into it. And I think there is an element of bubble which is happening in that IPO space now. Whether it will last for another year or more is tough to say. Can last. Bubbles often last much longer than you expect them to. I was just looking at performance of fund managers both in PMS houses and mutual funds over the last 10 years in different strategies against the benchmark. Unfortunately, lesser than 20% of the portfolio managers are outperforming the benchmark. So the vast majority are charging fees when ideally they should not be charged because they are not outperforming the benchmark. So I think the market will correct itself. More and more money will flow into passive, and that's been the trend last 3-4 years. And like the US, in the next 10 years, passive may become as big as the active industry.
So, in terms of sectors in today's time, what are the sectors that you think are people should study and there is probability of them doing well? Welcome to another episode of This or That. I am Bhartendra Singh. Our today's guest is Mr. Thomas Priju. He has more than 25 years of experience in capital market. He is a portfolio manager with Kama Capitals. Hello sir, thank you very much for being here.
Thank you.
Sir, यहीं से start करते हैं. We'll start with what is a portfolio manager, what is a fund manager, what do they do actually?
Sure. So typically the job of a portfolio manager, whether he or she is working in a mutual fund, in a PMS structure, in a AIF structure, or a hedge fund, or for that matter, even in a private equity structure, is to give returns to an investor which is higher than a benchmark. Now, the benchmark will depend on the objectives with which the investor gives money to the portfolio manager. So, to give an example, if it's a mutual fund scenario, you broadly have 3-4 broad categories of funds on the equity side. We'll deal more with equity because I'm more an equity fund manager. If you want, I'll provide color on the debt side also. So broadly, stocks, depending on their market capitalization, are put into different buckets. And in India, most of the mutual funds and fund managers follow the SEBI definition. So typically, the top 100 stocks by market capitalization are called large cap stocks. 100 to 250 are called mid cap, and beyond 250 are called small cap. So you have portfolio managers who are large cap fund managers. You have portfolio managers who are mid cap fund managers. You have portfolio managers who are small cap fund managers. You have portfolio managers who are mid and small cap. Then you have the last category, which is the broadest category. It's called either diversified or all cap. So they can invest in all the categories of stocks. Now, typically, if it's a large cap fund manager, his or her benchmark may be the Nifty. You can also use the Sensex. If it's a mid cap, both NSE and BSE have mid cap indices. And if it is a diversified, most people use the BSE 500. You can also use the NSE 500 because that's a larger canvas. So if a portfolio manager is taking money from a client, he has to ensure that his returns after fees is more than what the benchmark gives. So if you give me money, be it in a mutual fund structure or a PMS structure or a AIF structure, your expectation will be that after fees, I will give returns better than the Nifty. Similarly, if it's a diversified, you will expect me after fees to outperform the BSE 500. Because otherwise you can put the money in an index fund or an ETF and get the same return. So if I say I have some skill set, then I should be in a position to give you better returns than the benchmark. So the most important thing is the benchmark has to be defined. And then you develop a portfolio of stocks depending on your philosophy, your investment framework, your investment style, and over time periods 1 year, 3 year, 5 year. The aim is always to outperform the benchmark. And then what happens is there is competition also. So, suppose there are 100 funds in one category, the top 25 is in the first tier. So, all the fund managers want to be in the top tier. Only then you will get more money into your scheme if it's a mutual fund structure. Similarly, if you're a PMS or AIF fund manager, you will want to be in the top 5 or top cat. Only then you'll get more inflows into your fund. So that competition is there. So you have to ensure that while you meet short-term returns, long-term is also realized, and you also don't compromise on your philosophy and process.
So, sir, there are limited number of stocks available to all the fund managers. I mean, they can't invent whatever is there in the market. They have to invest and select from there. What makes the return difference between the two portfolios? You
Sure.
know,
So first I'll give you the construct of the benchmark, and then I'll tell you from which are the different sources of alpha creation from a fund management perspective. Typically, in most of the indices in India, financial services, which is banking, financial service firms, and insurance, the weightage will be close to at least 35%. It
Hmm.
can go up to 40%. So that's the largest sector. Then another large sector in India is IT services. That tends to be around more than 10%, 10 to 15%. Now it's a bit low because last 1 year has been bad for IT sector. Another large sector is healthcare, pharma, hospitals, diagnostic. That tends to be 8, 9%. Auto ancillaries is 8, 9%. Consumption will be another 10 plus percent, which includes FMCG companies. Then you have metals, which is another 10, 15%. And then you have oil and gas. So broadly, these will be the 7 large sectors. So the first thing one should be conscious of is that all sectors do not do well at all times. There are time periods in which certain sectors do better. So when you are a portfolio manager, 2, 3 things happen. For instance, for the largest part of my working life, I have tracked pharma, IT, and a few other sectors. So there will be a natural bias for me to be overweight those sectors. But if I go overweight IT, when the sector is doing badly, I can get penalized. So the first, similarly, if a large sector like BFSI is not going to do well, and you are pretty much underweight that sector at the right time, that can be a source of alpha. So getting the sector call provides a edge. But the larger edge, if you ask me, comes from stock picking. And how does that stock picking work? And what are the different nuances in that process? I'll try to explain. Whenever you need clarity, feel free to interject. Now, typically, the top 200, 250 stocks in India are pretty well researched by the sell side. And when I say sell side, you have broking firms who have large institutional research teams, so be it the Kotak's, be it the Motilal Oswal's, be it the AIFs, be it the Edelweiss, Novama, PNK. There are plenty of good sell side domestic firms, and then you have large FII firms in India, be it a Morgan Stanley, be it a Jeffries, be it a CLSA, be it a UBS. They all have teams of 10, 15 senior analysts, associates, and they all track the sector very well. Within the buy side firms, so presently I'm working in a PMS AIF structure. Before I worked in a mutual fund structure, I've also worked in a hedge fund structure. So large mutual funds like be it an SBI, be it an ICICI Pru, be it an HDFC, AMC, they'll also have an army of research analysts for all the sectors, and then they'll have associates, and then they'll have a team of portfolio managers. So you have people on the sell side and buy side researching the same companies. All these companies regularly come for conferences. They do their con calls every 3 months. So the information flow, and in the internet world, the information flow is very strong. So the possibility of information asymmetry in the larger companies, the top 100 or 200 or 250 companies, the probability is less. Having said that, there still can be information asymmetry. But when you go to the larger universe of stocks, below 250, there are still more than 1,000 stocks in India. There are few thousand stocks which are listed. So there will be another 1,000 stocks which can be invested in, which are investable. Some of them, few sell-side firms may be tracking. Some of them, only few buy-side firms may be tracking. Some of them, the history may be less. There may be no one tracking at a point in time. Because as a human being, you have certain bandwidth issues. If you have a team of 5-10 analysts, typically one person cannot actively track more than 30-40 stocks. You can have actively track 30-40 and do soft coverage of 20-30. So if a team is very large of 10 plus 10 odd people, then maximum the team can track around 300 stocks. Beyond that, they cannot track. So there will be a large number of stocks at any point in time which are under research. Second, what happens is, for various reasons, if a sector is not doing well or a company has not been doing well for a couple of years, there is a natural tendency among market participants not to be on top of it, because the perception is, for a few years nothing is happening in this stock or this sector, why track it? But life, and by extension of life I mean business cycles, and companies also have cycles. No one company does well always, no one sector does always, and even companies which have had a bad patch, the bad patch may last 2 years, sometimes 5 years, God forbid, sometimes it can last even 10 years or even more. But if you're not tracking that stock properly, you will not be able to catch the inflection point. I'll give examples of sectors and companies. For instance, cap goods used to be a sector which had a very good bull run in India from 2005-6 to 2008. Then for another 13-14 years till 2021, the sector was not doing anything. Many companies in that sector went bankrupt. But last 3 years, the sector is doing phenomenally well. At this point, again, it's doing well because there's more investment in power, infrastructure, other sectors. So cap goods as a sector has been doing phenomenally well. So if nobody's properly tracking that sector, or there are not many analysts who have been watching the sector over an extended time frame, he or she will not be able to catch the revival. And when a sector has not been doing well for 14 years, there's a natural tendency in many teams not to be looking at that sector. So people who might have been tracking that sector consistently, or at least doing soft coverage of that, or had some expertise within their team, will be in a better position to participate when that upturn comes.
For a fund manager who has so much of information available, who is deep into the sector, he's analyzing the companies. Still, it's so tough to identify good sectors, good company. People, investors who directly buy stocks, okay, not sure they have the right information. So if they were to track, look at a company and say, I mean, is the same level of research expected from them? So because I want to look at it this way, you mentioned some companies, and in recent past there has been so many IPOs, okay, some of them oversubscribed, and these companies are making losses. The people are just buying on the basis of brand, So two questions. One is that, what are the factors, things that people who are interested in doing, I will do direct stock buying, how should they look at it? First question. Second, in recent past, there have been so many IPOs where there's been controversy, news about saying that this company is overvalued or this company is making losses. Why is it oversubscribed? So, if you can address both these points, one is that, how investors have to look at this stock, and secondly, why this company is being oversubscribed if they are making losses? So investors fine, but how are fund managers looking at it?
So, Bhartendra, you have touched upon many important points, and I'll address it one by one. First question is whether, as a small investor, one should directly invest in equity. The traditional advice most people will give is, safer to invest in mutual funds, etc. I will say you should definitely directly invest in equity, but there should be a method in the madness. And you should not try to invest all your money yourself. You should give some to experts and some you should also try out on your own. For instance, it may so happen you are working in the IT sector, or you may be working in a bank, or you may be working in a pharma company. So, depending on where you're working, you will have certain expertise in that sector and you will know which companies are doing well in that sector. So, by extension, your judgment can be as good, if not better, than a fund manager or an analyst in that sector. So, that's a natural home advantage, and that you should not miss out. But businesses you don't understand, companies where you don't have a framework for valuing, you should stay out of it. Now, you are asking me why there is a frenzy in certain IPOs even when they are loss making. Now, we cannot generalize everything with one brush. There may be some companies which are loss making today, but who can have a very bright future later. There can be some companies who are showing short term good profits, but in the long term they may flop. But why there is oversubscription is two reasons. One is uh, it's become an easy way for institutional investors to make money. So, what happens is in many of these IPOs, there is a fixed anchor allotment which happens to institutional investors, and the floating stock will also be less. So there will be a time period, maybe 6 months or the first year after listing, in which the stock may not reach its fair value. Two, there is a high probability that many promoters and investment bankers, and in some cases they may be individually doing it, some cases they may be hand in glove with the accountants and auditors, they tend to dress up the numbers before the IPO. So suddenly the year before the IPO or around the IPO, the numbers look very good. And maybe a year after the IPO, the numbers start reflecting a different reality. Retail investors and also institutional investors are human beings. They get influenced by the mass psychology. So if a certain sector is in flavor and many people are applying and making money, there's a tendency to extrapolate that into the future. That this last few IPOs on listing, it's going up 30%, so we can make a quick money, let's participate. And more people get into it. And I think there is an element of bubble which is happening in that IPO space now. Whether it will last for another year or more is tough to say. It can last. Bubbles often last much longer than you expect them to. But there is definitely a bubble which is building up in IPO. And there are market participants with vested interest. The promoter wants to get the best maximum money on listing. Investor banker is getting his fees. So he will also push the issue aggressively. There is hyper competition among the buy side firms to show returns. So everyone will fight for the anchor book. And typically there is limited amount that a regulator or a third party can do, because this is human psychology at play. And somewhere down the line, this bubble will burst. What will be the trigger, you never know. But that is how the cycle of life and the cycle of markets are. You as an investor, what can you take? The precaution you can take is that if there is a certain company, if it doesn't fit your valuation framework, you cannot understand the business. You cannot understand why that company is getting that valuation. The stock may double, it may go up. If you don't understand it, the prudent framework, mental framework to do is don't participate. You may not make money over there, but if something goes wrong, at least you won't get hurt. Because there are 101 ways to make money in the market. You have to have your own philosophy, process, and stick to it. So I'll tell you, investing is like, a little bit like, suppose a person believes in God. he will follow a certain religion. You know, he may be, in my case, I am a Christian. In your case, you're a Hindu. There'll be somebody who's a Muslim, somebody who's a Parsi, and somebody who doesn't believe in God. Now, there can be periods of in my life, which can be a month, which can be a year, which can be many years, that the tide of life is not going in my favor. Does that mean that I will stop going to the church and start going to a temple, mosque, or some other new religion, depending on my incentive to get something? Don't. You have a philosophy, you have a process. So, similarly, what happens in investments is that you need to have a philosophy and a process. The problem is that most market participants take a long time to realize the importance of having a philosophy and a process and sticking to that discipline. Most people by nature are opportunistic. So they will jump from one flavor to another flavor. And when you do that, sooner or later you will have an accident. The only way to avoid that accident is to develop your own investment philosophy and process, which is more attuned to your character. I view philosophy and process as an extension of a person's personal character that will define his personal philosophy and process, and then stick to it. So, you may be a value investor, for instance, who gives a lot of emphasis to how much you pay, the quality of the business, the quality of the promoters. And in a momentum market, which may last for a couple of years, you may underperform. So be it. But if you have the discipline to stick to your philosophy over a longer time period, 5 years, 10 years, your returns may be better than the best. But you have to have that conviction to stick to your philosophy. And the extension of having the conviction to stick to your philosophy is that there will be periods when you'll have to experience pain. So there might be a couple of years when, my portfolio is not doing well, your portfolio is doing exceptionally well. I may get ridiculed by my sales team and my competitors that this guy has lost it. He's not able to give returns. So I have to have that ability to absorb that pain, to stick to the knitting, see that I am doing what I believe in, and then slowly the tide will turn. But these characters of, having a philosophy, having a process, that ability to take pain, these do not come naturally to human beings. So you have to train your mind. You have to develop that framework, and it takes time.
Would you like to give some example of these philosophies?
Broadly, there are two broad buckets. One is value, where you're very conscious of how much you pay for something. So typically, if something is worth 100 rupees, you'll never want to pay more than 90. You want a margin of safety. So that ability to value is very important. How you value it, It's like this in Bombay. People will go to Fashion Street or, buy something from the roadside, be it a Linking Road or Hill Road. But that same, or buy leather from Dharavi. But that same thing, when it comes to a showroom, maybe 3 times the cost. So somebody who's value conscious may go to Dharavi to buy his shoes or belts, or so that is some of value. But there is another breed of people who will say that, "Arey, this company is growing at 30%, 50%. For instance, last few years, Trent has been doing very well because Zudio has done very well for them. So on a 2-year forward basis, Trent is more than 70 times P. For a person like me to put money at that high valuation now will be tough. If I'm holding Trent, I may continue holding it. Whereas somebody else may say Trent is growing at 70%. So even if I pay a high P, I'm okay with it. So that's a growth investor. These are the two broad buckets. And then you have many layers, There's a filter called quality. What is quality? Quality is where finally the things get reflected in the numbers. High quality companies will have good operating cash flows, high EBITDA margins, high ROE, return on equity, high return on capital employed. Those are the financial matrices which are visible. But there will be other subtle parameters which give you an indication on the quality of the promoters. How does that promoter behave during good and bad times? During good times, does he overpromise? During bad times, does he give you the bad information in advance or he still gives you the rosy picture? What is his lifestyle? Is is he and his family only taking all the important decisions and he doesn't delegate? Is he a control freak? Does he have professionals around him who are equally, if not more qualified than him? Does he share the spoils with his employees? Is his top management stable? Do employees spend long tenures in the company? So there are many. How does he pay his dealers in time? If he takes a loan from a bank, does he ensure everything is on timely payment? So these checks when you do, you will understand the character and the DNA of the promoter. So typically, if you do your work properly and a promoter is of reasonably high quality, then that promoter may have periods in which he may go to a down phase. But the odds that he or she will come out of it is higher. So if it's a relatively high quality promoter and you bet on him or her when the chips are down, the probability of you getting outsized returns is high. You have formed your judgment on the promoter, you have understood the business. God forbid, for some reason, the current year and the next year may be tough for him, but that gets reflected in the price in a more dramatic fashion because many market participants are momentum driven because everyone has to show short term performance. So typically, when somebody is going through a down phase, the stock will tend to correct more than it's required. So that will become a good hunting ground for somebody who's value conscious. Similarly, when the going is good, people will overpay. They will make him the next god. So you should know when to get out of that gravy train, not to want the last pound of profit. So in both cases, there will be overreaction. And how you navigate that is also very important and it can become a very important source of alpha for a portfolio manager.
There is a traditional advice that, you should buy and forget. Like a bhul jao, right?
No, that's not advisable.
So how,
And I'll tell
this
you why.
marathon race and buy and forget, what's the right approach?
Because see, I'll tell you, human beings are fragile.
Hmm.
Just because a HDFC bank did well for a time period or just because a particular human being had a success for a certain time period, to extrapolate that person will be like that till he dies is foolishness. Because be it human beings or institutions, they will make mistakes. And that's the nature of the beast, human being, No human being is flawless. So an Elon Musk will make mistakes. And even a Tata will make mistakes. So you cannot have a buy and perpetual hold for anybody. There's no holy grail over here. Having said that, if an exceptional person comes on board and starts a company, so the Infosys of the mid 90s, Narayan Murthy and Nandan Nilekani and team, or the HDFC Bank of the late 90s in which Aditya Puri and a bunch of people came and built a very good private sector bank in India. So if you have an extraordinary promoter along with a sector which has a long way to grow, if both of these characters fit and you're lucky enough to get one or two such opportunities in life and you're wise enough to recognize it, then it's possible you can ride it for 5-10 years or even 15 years. But the world in which we live in now, as compared to say 20 or 30 years back, is that what is happening is that because of technology, because of changes in people's taste, changes in people's behavior, the ability to build businesses that will thrive for an extended time frame is becoming tougher and tougher. Having said that, we have good global companies like Apple, Google, Meta, Amazon, who are doing well even in this tough environment for 10-20 years in a row. But companies like these are few and far between. So typically, if it is a exceptionally good management with a sector which has tailwinds, you might be able to sit tight for 10-15 years. But such opportunities are few and far between. Most of the great opportunities will be those which will give you a 5-year window. because the sector tailwind will not last forever. And typically, a great manager, along with a great team, after 15 years, some great people in that team will leave to start their own. After 15, 20 years, the person who did exceptionally well, the best phase of his life may be over. And in certain cases, success may go to that person's head. And then the cycle of life will catch up. After that uptick, he will also, the law of averages will catch up. So if you're very lucky, you might get a company where you can sit tight for 15 years. But more often than not, you get the opportunities where you should sit tight for 5, 6 years. And then there may be a few opportunities which may be just for a few years. But where you can sit tight for an entire lifetime, say 50 years, 60 years, I think will become tougher and tougher.
An average investor is very confused, the kind of questions that you see they are asking, to deploy 50,000 rupees, 1,000 rupees, 5,000 rupees, even 1 lakh rupees is not a big amount. For a fund manager, he gets a large amount to manage, 100 crores, 500 crores, 5,000 crores. What is the mental framework to manage that kind of money? Because a fund manager's role is not just to give the return, also to manage risk. So what's the framework? How do they manage risk?
I think the framework, whether you're handling small pools of capital or large pools of capital, the framework doesn't need to change. The golden framework to apply is that if it was your own money, you would not invest in that company. When you're managing third party money, use the same yardstick. If what you will do with your own hard earned money, only do that with third party money. The most important thing is to ensure that you don't have permanent loss of capital. Even if you underperform, it's fine, but you should ensure that you don't lose capital, especially third party money. See, if it's your own capital and you lose it, no one may question you. But if you give me money, you give me 1 crore, and after 3 years that 1 crore, God forbid, has become 75 lakhs, what will be your opinion about me? How will I face you? Whether that 1 crore becomes 2 crore or 1.5 crore, I can still justify it. But if there is loss of capital, it's a permanent damage for me. So that's the most important yardstick, to ensure that there is no permanent loss of capital. Most important. If you are investing the money yourself, or if you're investing it for third party, whether it is 1 crore or 1 lakh crore. Don't have double standards. If you will not invest your own hard-earned money, don't invest third party money. And don't have any vested interest. Don't try to do anything which is unethical.
I had a guest on my podcast. He said, so I asked about, so, no fund will perform, top quartile always, right? There will always be underperformance. And so he made a comment saying, no, it's a role of fund manager to ensure this always performing. That's what he gets the fees for. Okay. So the question is this, right? That, you have done your research, you have studied the market, studied the companies, and you made a portfolio and you took a bet on some sectors and some companies. These companies, these sectors, let's say are not, and your call is wrong. Okay. How do you recover from it? And uh, what is the time when you say, okay, fine, it's a mistake, I have to change this now? What is that period? It's not that today I've invested, deployed certain amount of money, and I realize, oh, it's not working, I can't just pull out the money, right? So how does this process go into a fund management process, right? You have done your research, you've thought about it, you deployed, you took a call, okay, this sector is going well, and in this sector these companies are going to do well, but then you realize it could be a black swan event or whatever, right? That sector is not doing, or generally maybe some pointers you missed. Then how does a fund manager go about it?
As a rule, the earlier you realize your mistake, the better it is. But let me build how the things can play out in the real world. So typically, and what time period to give, underperforming stock. I personally will give it, because I come more from a value school of thought and I'm a bit more patient. And I also like to invest in turnaround companies. So if you ask me, I'll give it at least 3 years. But most people in the fund management industry may not be patient to wait for more than 6 months or max 1 year. But I'll tell you the more subtle and important aspect of how to handle this game. When you're building a portfolio of stocks, suppose you have 20, 25 stocks, all of them cannot be such risky bets. You may have few, two, three such bets, which are companies which are going through a tough phase. But after understanding the mindset of the promoter and the management and the business, you feel after 1 or 2 years the tide can turn. But typically in life, what happens is that, when you're on the back foot, the momentum is against you. To come back in life usually takes longer than you expect. So you may expect a company to start doing well after 1 year, but that 1 year can sometimes become 3 years. But in that entire period, you should keep meeting the management regularly to understand why it's taking longer and whether they are doing the right things and whether finally the change will see the light of day. So you have to be on top of it. And you can afford to do this only with a few of your stocks, because if a large part of your portfolio is underperforming, then the pressure will build on you from the outside world. And then you'll be forced to sell something which you don't want to sell. So the first part is that this experimentation can work only with a part of your capital. If you are managing third party money, it cannot be a disproportionately large part of your capital. Two, you need to have a honest conversation with your clientele, be it the investor or if it's through a distributor, with the distributor, that your style of investing requires certain time frame for the results to show. So if the investor knows that this is how the portfolio manager manages, then I need to look at the returns over a 3 year or a 5 year time period rather than over a 6 month or a short time period, then the investor is also willing to give you that time. Having said that, there can be scenarios in which your judgment of the promoter was wrong. You thought he's a honest guy, and suddenly you realize that his intention is something else. Then the time to sell is when you realize you have made that mistake. When you realize that God alone knows. That there's no perfect science to that. Similarly, there can be a scenario where, despite your best intention, despite the promoter's best intention, the landscape has changed. And there is no visibility that things will improve. Promoter is a good guy, but the scenario has changed. There's maybe intense competition from China, or because of tariffs, the damage is so deep that, for another few years, things may not change. In that scenario also, it is better because you don't have a very long time period. You have to show performance over, 1 year, 3 year, 5 year. You may decide to get out. So there can be scenarios, but when you will decide to sell it will differ. But the earlier it happens, the better. Just because a couple of quarters is bad or a year is bad, to push the pedal and push the button and say I'm going to get out will not be a prudent approach. But where you feel there's no visibility on improvement or your judgment has been wrong, there the moment you realize it, it's better to get out.
So, sir, I mean, in a PMS structure or an AIF structure, the interaction between the portfolio manager and the investor may be slightly higher. Okay. Uh, but in a, let's say, mutual fund structure, okay, I don't think, all investors, especially small investors, get to interact. And also, they don't have that kind of understanding. And typically, what happens is, fund underperforms, and there is enough information, enough platforms available where they can compare it to benchmark or compare it to other funds. It's not performing, they exit. Okay, so what would you say to such investors?
I got it. I got it. So I'll tell you, you should be, if the fund manager is working with a mutual fund, you should be patient with that fund manager. And if you ask me, you should judge him over a 5 year cycle. Just because 1 year has been bad or even 2 year has been bad, you should not shuffle the portfolio manager. I will suggest once you have gone with a certain portfolio manager, and if the portfolio manager continues to be that same person in the same form, if even after 5 years the person is doing a lousy job, then you have every right to get out. But don't form a hasty view based on 1 or 2 years, because sometimes 5 years is a reasonably long time to see if the person is good or bad. 1 or 2 years may be too short a time period.
So this period in which we are looking at the performance, is it okay to just if it's not beating the benchmark also, then also okay, or or we have to just look
So
at
I'll tell you,
competing
yeah, this is
funds.
a very complicated topic. I was just looking at performance of fund managers both in PMS houses and mutual funds over the last 10 years in different strategies against the benchmark. Unfortunately, lesser than 20% of the portfolio managers are outperforming the benchmark. So the vast majority are charging fees when ideally they should not be charging because they are not outperforming the benchmark. So I think the market will correct itself. More and more money will flow into passive, and that's been the trend last 3 4 years. And like the US, in the next 10 years, passive may become as big as the active industry. So I think as a portfolio manager, if over a long time period you cannot create alpha, you don't have the right to charge your consumer, which is then you're not being true to yourself. There is a large segment of the market which is charging and not delivering results. That's the harsh reality. But what time period to give before forming a judgment? I'll suggest you should give the person 5 years. And if after 10 years even the strategy is not outperforming the benchmark and still the people are putting money, that means they're not doing their homework well. Or the selling machinery is so strong that they're able to fool people.
So between passive and active, are there enough mutual funds, good quality? I mean, how do you compare? If it's a passive fund, it's following probably a index, right? So is there a way to
So
evaluate
I'll
a
give a
passive
very
fund?
simple framework. See, typically if the financial institution has been sponsored by a large bank.
Hmm.
So which are the large banks in India? HDFC, ICICI Bank, SBI, and then you have few more good, reasonably good banks like Kotak, Axis, etc. So typically, the children of a mother bank will tend to be average or above average. You will
Mhm.
not find a very uh, and the same rule if you see in the US, if it's a product of a JP Morgan or a Goldman or a Morgan Stanley, or in the Japanese scenario of a Nomura, if the mother bank is good, the subsidiaries of that mother bank also will have a certain standard. So typically, if it's a mutual fund of a HDFC or a SBI or ICICI, there will be certain checks and balances. That's a safe approach. Similarly, if they are an offshoot of a large corporate with a more than 100-year track record, be it a Tata or a Birla or somebody, anybody, they will try to ensure there are certain standards because they don't want their mother brand to get impacted because of the lousy job of a subsidiary. So typically the probability that a small investor will get hurt in such institutions are lower.
Hmm.
That is the way to reduce your downside risk. But every 5 10 years, there will be institutions who come up and do a tremendous job. So if you ask me in my field, I feel Parat Parekh as an investment house has done a very good job in the last 20 years. But many people may not be aware that the name will not be such a big brand, all over India. So every 5 10 years, some good fine institutions will come up. You have to be discerning, and then those people will also benefit.
So between the structure of investing equities, mutual fund, PMS, and now there is an SIF. Like, could you explain these? How they differentiate.
Yeah,
See, if I have some money, I mean this. I'm investing in mutual funds, and let's say I build a certain portfolio. Why should I go to PMS? and now why there is a new, and how will this SIF make a difference?
So the Indian context, both from a taxation perspective and the vehicle structure, mutual fund is by far the best. And that's the reason the largest pool of assets is in mutual funds. The regulator also has preference for that vehicle, and mutual funds will continue to be the largest component of the fund management industry for the foreseeable future. And there are several good mutual fund houses in India now. The industry has evolved, over the last 30 years. PMS AIF is typically, there used to be depending on the vehicle, there are watermarks, minimum corpus has to be 25 or 50 lakhs or 1 crore. So, by definition, it is for an HNI investor. There can be certain PMS fund managers who, due to either their own individual brilliance, the team structure, their cumulative experience over long time frames, maybe they are able to generate better alpha. So if you are a HNI and you can identify such PMS fund managers, then it is worthwhile putting money in the PMS fund manager. Now SIF is a new vehicle which SEBI has created where the corpus is 10 lakhs. Whether these MFs will dominate this industry or PMS or AIFs will dominate this industry is too early to say. But the probability that mutual funds can make inroads seems to be a bit higher for me. People who have large mutual funds may find it easier to tap the SIF audience. So, how the evolution of the investor can happen is first he can try the mutual fund in small quantities. Once his wealth increases, he can put in SIF, which is 10 lakhs. And then when the wealth increases further, he or she can put in a PMS or AIF structure. So, there are some good PMS AIF fund managers who have started their own mutual funds. And there are mutual fund houses which have their own PMS also, and now they'll have their AIF structure. So it'll be, I think this SIF structure will also become pretty large over the long run. But mutual fund vehicle per se, because of taxation and many other purposes, is a very good vehicle for Indian investors.
So
But there will be some PMS and AIF fund managers who one should definitely keep on the radar, because it's possible that some of them might outperform certain mutual fund managers. May or may not.
I mean, everybody wants to, rate a fund manager, saying, what is the performance of a fund and who is a good fund manager. There's no matrices for being a good investor, because uh, so many things that applies to a fund manager that he should be doing to, manage the fund. It should also apply to, what are some good things or a investor should do and what they should avoid. So what makes a good investor? What are the characteristics or uh, yardstick of being a good investor? Or other way to ask this question is, market has definitely given returns over last 2 decades, 3 decades, but not every investor has made money in the same market. What is the reason for this?
So I think there are different paradigms to use to see who can be a good investor. One is where it's a little bit like, if you go to a certain school or you go to a certain college or you start your career with a certain place, the odds of success increases. So typically in your investing career, if you have worked with great minds at early phase and your philosophy and process has evolved, the probability of success improves. So if you have spent time early in your career with some great investors, that will help. And history is a testimony of that. So if you take the greatest investor, which most people acknowledge as Buffett, he was taught by a great professor, Benjamin Graham at Columbia. And he was also lucky to have a great partner in Charlie Thomas Munger. And that partnership lasted more than 60 years. So he was lucky to have a great professor early in his career, a great partner as an investor, and third, a long life. Now he's close to 95. So the ingredients are a great education, a great temperament to learn all your life, certain character traits like humility, generosity of heart, ability to share knowledge, not to be over attached to money, ability to be rational, ability to have less biases in your mind, not to be very much ideology driven, patience, a good temperament, general awareness about what's happening, in your immediate environment and all over the world.
This is an interesting point. There is so much of information available, and people keep talking about events and everything. So as an investor, okay, what are the things they should be tracking to be aware of the sectors they are invested in, and the funds that they're invested in? What should an investor track? I mean, so one is very simple thing. You trust an expert fund manager, give them money, and you just rely on their expertise, and then you don't have to track. For people who are saying no, I want to invest myself, or certain portion of my money I want to invest myself. What should I be tracking to be aware of of the markets, general trends?
It can change depending on the business. So every 3 months you get the results.
Hmm.
But for instance, when you go shopping,
Hmm.
suppose you are lucky enough to land up in a Zudio store 2 years back,
Hmm.
be it a Borivali or any suburb of India, and you see on a weekend or even on a weekday that it's full of people. You can get a sixth sense that something, that company or that brand is doing well, that's attracting so many people. Similarly, if you see your friends buying more of certain vehicles, it may give you a certain inkling why this brand is suddenly picking up favor. It can be a consumer durable, it can be an AC, it can be a two-wheeler, it can be a four-wheeler. If it is a hospital chain, you happen to have certain somebody who's a doctor over there working, and or you as a patient experience some hospital chain and you have a very good experience, that can be another trigger. But if you ask me, the safest is to keep reading, because sometimes you may read 100 times and you may not get an insight, and then suddenly out of the blue something will give you an insight. So reading, staying in touch with people, with youngsters, middle-aged people, old people across age groups, and people from different areas of life. Suppose all your friends are from the stock market, it'll be a problem. If you're lucky enough to have a few friends in the family or extended family who are doctors, somebody who's a good engineer, somebody who's working in another part of the world, if you're lucky and you have wealth, you travel a bit. See, as institutional investors, we have a certain advantage that there are a lot of conferences, a lot of sell side research we get, so we get information access more easily. Uh, but if a person is not lucky to be a part of an institutional setup or a network of friends, suppose you have 4 5 friends who are very well read. So you might have a expertise in few areas, he may have his expertise in something else. So you have to develop a network of friends or ecosystem like that. But reading is very important.
Any good books that you would recommend on investing?
So among the ones I have read and which I have found very good is Charlie Munger's book, uh, Poor Charlie's Almanac. It's a
Poor Charlie's
almanac,
Almanac.
ALMANACK. He has modeled his life on Benjamin Franklin, and Benjamin Franklin used to give lectures under the pseudonym of Poor Richard. He's one of the founding fathers of the US. So there's a small black book called Poor Richard's Almanac. Charlie Munger's book is more extensive. Poor Charlie's Almanac is a wonderful book. Then there's a old book written by an operator in the US, based on the life of an operator in the US, Reminiscences of a Stock Operator. It's a life story of Jesse Livermore.
Jesse Livermore.
Jesse Livermore. He used to be one of the largest operators in the US market between 1900 and 1920. That's a nice book. Peter Lynch, there's a good book, One Up on Wall Street. There's a book which is a collection of interviews with great investors and traders. That's a wonderful book. Then,
What's the name of this book? Interview?
so I'll tell you the name. It's called Market Masters.
Market Masters.
Yeah. These are the three, four, I think, good books which deal with practitioners, and that Market Masters is good.
So, in terms of sectors
Yeah.
in today's time, what are the sectors that you think are, people should study and there is probability of them doing well? What are these sectors in India?
So within pharma and healthcare, CDMO is a sector which will do well next 5-10 years.
What is a CDMO? Could you explain?
So which I earlier alluded to. So suppose you're partnering with a innovator company in the US or Japan or Europe, and you develop the active pharmaceutical ingredient for that company. So you're involved with the innovation from early stage, be it phase 1, phase 2, phase 3, and if that molecule becomes a blockbuster, then the quantities you supply increases. So a lot of innovator companies in the US are becoming more comfortable with the API companies in India. Two, they want to diversify away from a Chinese manufacturer. So these factors, both in small molecule and in the biologic space, is creating a lot of headroom for growth. Two, in the consumer technology space, be it a Zomato, be it a Swiggy, be it a urban company, more IPOs are coming because India is good in technology and we have a large consumer base. So smart promoters who are able to understand the consumer needs and give technological solutions, there will be always very good companies in that space. Banking as of now is going through a relatively good phase in India, so banking may and good NBFCs may continue to do well. A lot of investments are continuing to happen in power and renewable energy. So companies which are in the renewable space or which are providing equipments to power-based companies or renewable companies, those companies may continue to do well. Consumer discretionary has been going through a relatively soft period, but I think hopefully once the GST cut benefits, the salary benefits which the government provided in the previous budget for income up to 12 lakhs, and hopefully once we have a long-term tariff agreement with the US, slowly consumer confidence and consumption in India might also pick up. So any good consumer discretionary firms, slowly the trajectory should improve for them also. So these are, and IT also has had a prolonged slowdown. Maybe over time, companies which can benefit more from artificial intelligence or companies who can do more application work in the area of artificial intelligence will benefit. So these are 6, 7 broad areas where I feel a lot of opportunities will come. And in India, you have good companies in multiple sectors.
What is your view in diversifying internationally? Because last couple of years or maybe a year or so, a lot of people are talking about home bias and they're saying you should diversify internationally.
Yeah.
So you think there should be some portfolio to be invested internationally, some amount of
So
amount?
personally, I have not yet started that, but I have a few friends who are doing up to 20% of their portfolio. And last 12, 15 months, Indian markets have given very substandard returns. But US markets and more specifically certain stocks on the NASDAQ and the US markets and other markets have done very well. And a lot of innovation is also happening in countries like China and other parts of the world. So if you have a mental framework and some methodology to track these companies and you have a reasonable amount of wealth, I think definitely a part of your portfolio you should look to invest outside India. Definitely you should, because there will be time periods when certain companies outside India are doing exceptionally well when the opportunities in India may be few and far between. So if you are able to ride that, you may get better returns at a portfolio level. But you have to develop the knowledge for that, which may not be everyone's cup of tea.
Let's say someone has taken care of their emergency fund and insurance and does it make sense to have for a younger person to put 100% of his investment money in equities or in terms of asset allocation? Because whatever you say at the end of it, people want return, and historically, other than equity, nothing has outperformed equity except for the gold in recent times, this recent. So, what is your view on that?
There can be a tendency to put 100% of your surplus money in equity. Some people may even borrow and put in equity. It can work in your favor in certain periods of life. In certain periods of life, it can backfire. If the bear market lasts for say 2 3 years and you borrow money, so your borrowed money, there's a loss of capital plus you have to pay interest on it. Or if you have some sudden expenditure for which you need money. So a more prudent approach will be to always have some amount of money in fixed income also. Because God forbid if you lose your job or you have some medical emergency. Suppose you invest in something that 100 rupees becomes 75 and you have 30 rupees in fixed income. You can also then redeploy and put more money. But if already you have put your full money at 100, then when it becomes more attractive, you don't have surplus money to invest. So the prudent approach is to have some part of your money in fixed income at all times.
What are some good instruments of fixed income? Where should people put that money?
So the bank FD and savings is the most simplest. You can
But
put
there are
in,
no returns there. I
yeah,
mean,
FD may give you still 6 7, but more if you want to go beyond that, then you can put in liquid or debt oriented mutual funds, or you can put in FDs with corporates or NCDs with NBFCs and other corporates where the returns may be more. Can earn even 12 13%. Certain NBFCs on their NCDs you can earn more than 12 13%. So these will be the few options in the fixed income side. On the bank FD you may get 7%, and certain NCDs with corporates you can get even 13 14%. So from 7 to 14% depending on your risk. But why I initially suggested bank is that to withdraw money is faster. If you want something has fallen a lot and you have some idle funds, if it's even with a mutual fund, you can withdraw it fast. Whereas certain NCDs may not be so liquid.
it's been a very nice conversation, insightful, uh, maybe a bit technical for few, but it's been very interesting. So, to sum up, any young person watching this, who is starting his investment journey, what would be your guiding framework for him? How should a new person is starting their journey? How should they start building their portfolios? How should they look at it?
So broadly, 2 3 things I'll suggest. One is first, before you start investing, be well read so that at least you have a reasonably sound mental framework. Try to develop some good mentors who can guide you. Initially, start with small pools of capital so that you can learn from your mistakes. And as your confidence builds and you have learned from your mistakes, become more adventurous. Be a continuous learner. Develop a good network of friends. Be humble. Be patient. Look at it for the long haul. Don't be in a terrible hurry to make money. Try to survive for the long run. Over the course of a long career, you will definitely get success. Uh, but you should have that mental framework to survive the tough periods. I think it's a long journey, like most aspects of life. If you do it in a calibrated manner, you'll also enjoy it more.
To conclude, I mean, I should have asked this earlier, but would you like to give an example of a call that you took in terms of, I don't want to name of the companies or anything, but you thought something should work, it didn't work, and something that really worked, and what was the thought behind both these two
So in
things?
my style of investing, I put a disproportionate amount of money in companies which are going through a temporarily tough period. But I form a view that over a 3 or 5 year cycle, they'll come out of it. Area where I have tried to fine tune my strategy is that very often you enter into a turnaround company at a certain price, and that turnaround may take more time to materialize. So when to double up or to increase your exposure is very important. So suppose you invest in a turnaround company in any sector at 100, and after 1 year that 100 has become 80,
Hmm.
and then slowly the good time is going to start. So the amount of money you invested at 800 should not be a large part of your capital, and the amount of money you invest at 80 should be a reasonably large part of your capital, so that the pain is lesser. If you had put everything at 100, the pain becomes more. If you have surplus to invest when it comes down to 80, you can have a larger holding in that stock. So that is a fine tuning of the approach, and to have conviction in one's belief is very important. See, sometimes no third party will give you that conviction. It may not come from your friends, it may not come from your family. Even the promoter himself may become despondent on his or her business. But your ability to have conviction in your own beliefs based on good groundwork and a good intention will definitely be rewarded. But you should fine tune how you deploy that capital so that you can reduce the pain during a down period. That's been a big learning, so that you increase the allocation when the improvement is starting or beginning to start. And this I learned from one of the interviews in Market Masters. I'm not getting the gentleman's name, but he was a master at increasing his exposure at the right time. So he used to increase his exposure after there is a quarter of 1 quarter of outperformance. He will not, during the underperforming period, he will not deploy too much capital. But when after 1 quarter of outperformance, he will jump in. That is a very, according to me, is a good way to fine tune the approach of investing in companies which are going through a temporary lull period.
Thanks, sir. Thank you very much for your time today.
Thank you.
And I hope we'll find value in this discussion.
Sure.
Thank you.
Thank you, Bhartendra. Thank you very much.